Hi, good evening. Today we'll be looking at IS 37, IS 37, IS 37 provision, contingent liability, and contingent asset. Just a quick one before I proceed. I would like to appreciate everyone that watched the previous videos, and please do not forget to subscribe so that you can get um, a notification as soon as I drop a new video on the standards. Okay, so as I was saying, I'll be looking at IS 37. IS 37 is provisions, contingent liabilities, and contingent assets. So this is the standard we'll be looking at today. And what we'll be focusing more on is the three major things, which is the provisions, the contingent liabilities, and contingent assets. Yeah. And the bulk of it is actually provision. Contingent liability and contingent asset it's pretty much straightforward. So we won't really spend a lot of time, but we're going to also deal with that. So let's start with the first part, which is the provision. But before then, it is also very important that we talk about what the scope is before we move to the definition of provisions, contingent liability, and contingent asset. So the question is, what are the scope of IS 37? Now, IS 37 excludes obligation. I'm waiting for the note. Please, kindly know that you can download the notes. There's a link in the description part where I've dropped the notes. You can download the notes there. Okay. As I was saying, the scope, IS 37 excludes obligations and contingencies arising from one, financial financial instruments that are in the scope of IAS 39 and IFRS 9. It excludes it, so please take note of that. Two, non-onerous and executory contracts. That's another one that is excluded from the scope of IAS 37. Three, insurance policy liabilities, but IAS 7 does apply to non-policy related liabilities, so please take note of that. Then, items covered by another IFRS or IAS, for example, construction contracts, applies to obligation arising under such contract. IAS 12, income taxes applies to obligation from current and deferred income tax. So then IFRS 16 leases applies to lease obligation, and IAS 19 employee benefit applies to pension or other employee benefit obligation. Then lastly, contingent consideration of an acquirer in a business combination under IFRS 3. These are the types of provision that is excluded from from IS 37. Kindly note this. Okay, now the thing is, what actually led to IS 37? What were the concerns before IS 37 was actually released? Because something must have led to something before a standard is released. Is either there was an issue or there's an inadequacy. But so what was the main issue with IS 37? Now, the first thing is it is not satisfactory for recognition of a provision to be based on intention to incur expedition rather than an obligation. So the first thing is the standard setters just look at it and said in the past, companies actually make provision based on intention and not obligation. But now that is essentially wrong. And one of the reasons why IS 37 was released was because of this. Two, it is not acceptable to aggregate into one large provision several future years worth of expenditure, including those related to ongoing operation which is then reported as one of cost, so-called big bad. So some people just drop in expenditure that is what, or like um expenditure that is worth more than a year value. For example, you're on a long run expenditure for 5 years and you're packing the whole of the expenditure for that 5 years in a single year. Now, this is one of the reasons why ISS 7 was brought into place so that it can be controlled. Then lastly, the lack of a structural framework of disclosure requirement for provision also resulted in inadequate disclosure. So because there was inadequate disclosure in the past, the standard was released. Okay. Now, the question is, what is provision? What is provision? Now, provision is a liability of uncertain timing or amount. Please take note. Is a liability of uncertain timing or amount. Now, I will take that again. Provision is a liability. I need to include that. Provision is a liability of uncertain timing or amount. First, you need to know that there must be a liability before it's provision. You don't just make provision based on intention. So, not intention. There must definitely be a liability. Now, uncertain timing, which means that you know that there's a liability, but the timing of the payment of the liability isn't sure, maybe due to some unforeseen or some unknown factors. Then, in some other cases, the amount is not certain. Take, for example, at the end of the year or during the year, maybe towards the end of the year, a customer takes a complaint into a customer takes a complaint to court, and the complaint actually receive a notification from the court, right? That there's a particular issue that they need to sort out in the court. Now, at that point, the company is not sure of what exactly the amount is going to incur. One, he's not exactly sure if he's actually going to even incur that particular amount. But then there's a liability probably based on there's a liability probably based on past relationship with that particular customer, which can be constructive obligation, right? Or it can actually be constructive obligation, for example. So the company is not sure of what the liability is, the amount of the liability is, or when exactly is going to have to pay that liability. But then there's a liability. We'll get to that as we move on in the class. Now, the next thing I'm going to look at is what is a liability, right? Don't forget, a liability is a present obligation of an entity, right? A liability is a present obligation of an entity from past events, and of which the settlement of which is expected to result in an outflow of an entity from the entity of sources embodying economic benefit. So please take note of that. Now, I haven't said that and I haven't defined provisions. Let's look at what is the recognition criteria of provision. Recognition criteria. What is the recognition criteria of provision? Now, there are about three criteria before provision must be met. Now, the standard was a bit strict in the sense that all three criteria must be met. And that is why you can see in the note that what we have is and not or. So all the three criteria must be met. Now, the first criteria is there must be a present obligation. Now, this present obligation can arise from past events. So first, there must be a present obligation. The obligation can arise from a past event, which can either be legal or constructive. We're going to get into this shortly, but just have that at the back of your mind. The first criteria, which is very, very important, is there must be a present obligation arising from past event, and this could actually be what? Illegal or constructive. Now, the next thing is payment is probable. Payment is probable. Now, what does that mean? More likely than not. More likely than not. Payment must, payment is probable, more likely than not. Now, what does that mean? Very simple and straightforward. It means that the percentage or the likelihood of you making that payment is more than you not making the payment. What does that mean? Let's say typically if it's 1% likelihood of you making payment, that is payment is probable. Now, the next one, which is the last one, is the amount must be what? Estimated reliably. The amount must be estimated, or sorry, can be estimated, can be estimated reliably. The amount can be estimated reliably. What does that mean? It means that to a large extent, you can determine what the amount or what the value of this obligation is. Now, take note, all three must be met. All three criteria must be met. All three criteria must be met. If two out of the three is met, then it's no longer a provision. Now, that will take us to another one, which is contingent liability, but we'll come back to that shortly. Okay. Okay, I think it might be worth just talking about that before we move further. Now, let's look at contingent liabilities. Now, like I said, if all three criteria are not met, if two out of the three criteria are met, but it is important that there must be a present obligation. Now, what does it mean? Let's first look at what is the definition of a contingent liability. I have it also in these notes. Let me just quickly go down to where we have it in the notes. Now, what is a contingent liability? It's very, very simple. A contingent liability is what? A possible obligation. A possible obligation that arises from past events, right? Whose existence, I'm reading from here, whose existence will be confirmed only by occurrence or the non-occurrence of one or more what uncertain future events, not only within the control of the entity. Now, I will underline some things there. Possible obligation, right? Past event, right? Now, occurrence or non-occurrence of one or more uncertain future event, not only within the control of the entity. Now, this is one of the definition of contingent liability. Now, what does this mean? I'll just quickly highlight a thing or just give you an example of this. Now, take for example a company, right? Should we say a company? Um, just trying to look for a simple illustration. Okay, let's take for example, you had an agreement at a point with, for example, your landlord. Let's just use that as an example. And you told your landlord at the point of entering the house that, oh, Mr. Landlord, in I'll be in this house for 5 years, but then I can promise you that within these 5 years, currently I'm collecting a salary of, let's say, 20,000 naira as an example, and you're telling the landlord that if in the first 3 years my salary increased, this is just a typical, it's just an example, not necessarily a real life scenario. If in the first 3 years I'm going to be receiving, if my salary increased by, let's say, 5,000 naira to make it 25,000 naira, now to the landlord, I'm going to increase your rent. I'm going to increase the rent I am paying by 250 naira as an example. Now, what does this mean? It means that this additional liability of 250, as a result of signing this contract of 5 years, this additional liability of 250, right? What does it mean? Is as a result of uncertain future events. What is that certain future event? That my salary will increase by what? By 25,000 naira. Sorry, my salary will increase to 25,000 naira by 5,000 naira to 25,000 naira. Now, what is it? It is an uncertain event. Now, you can see one or more future uncertain event. Now, what is the occurrence we are even talking about here? The occurrence is the increment in the salary. So the occurrence or non-occurrence, now in this case, is the occurrence that there will be an increase in salary. Now, if my salary should increase by 5,000 naira to 25,000 naira, then it is likely that I'm going to incur a liability of 250 naira. Now, what does this mean? This is a contingent liability because this liability will only be triggered if I have what? An increment in salary. Kindly know that. Now, that is the first part of a contingent liability. Now, there are also other parts or other things that can lead to a contingent liability. For example, from our definition or from the criteria recognition of provision, we said three things must be present. However, if the three are not present, if two out of these three are present, most importantly, if the first criteria is present and any of the two criteria is present, right, then it can be a contingent liability. Let's look at that. Now, a present obligation that arises from past event but is not recognized because it is not probable that an outflow of resource embodied economic benefit will be required to settle the obligation. You are not sure of the amount, or sorry, you are not sure if the payment is probable rather, or the amount of obligation cannot be measured with sufficient reliability. Now, this is the link. This is another link, right, between provisions and contingent liability. Now, what do I mean by this is the link? Now, essentially, what I'm just saying is that a provision, the three criteria must be met, right? Three criteria must be met. Now, a contingent liability, if two out of the three is met, but it is compulsory that the first criteria is met. Now, what is that first criteria? The first criteria is that there must be a what? Present obligation. So please take note of that. That is why if the three criteria are not met, but the present obligation and any of the two is met, then it still can be, because you are unable to recognize it as a provision, then you can disclose it as a contingent liability. Okay, so that's all about contingent liability, right? Now, so we've looked at three things. Now we've looked at the reason why the standard was released. Two, we've looked at the definition of provision. Three, we've looked at the criteria of provision. Four, yeah, so four things we've looked at. The fourth is we've looked at what a contingent liability is. Now, let's now look at the obligating event. Now, first, I think I've read this, but let me just reiterate. Now, if any of these conditions is not met, no provision should be recognized. So, provision, right, when these three criteria, if they are not met, I said it earlier, right? If the three criteria are not met, if any of the three criteria are not met, then you are not to recognize a provision. Then what do? Then you disclose. Now, an intention to make a payment is not enough on its own to justify provision. There must be an actual obligation to make a payment. So please take note of that. Now, what is an obligating event? We said that a provision arises as a result of past events. So let's look at what an obligating event is. Obligating events. Now, what is this obligating event? Now, an obligating event is an event that creates a legal, please take note, a legal obligation or a constructive obligation. Now, these are the two things. These are the two things that arise from an obligating event: a legal obligation or a constructive obligation. Now, and therefore result in an entity having no realistic alternative, which means that you cannot escape the liability, but an alternative but to settle the obligation. Now, what is a constructive obligation? Let's start with that. Yeah. A constructive obligation arises if past events. Now, please take note. Let me start with legal. Legal is pretty straightforward. Legal is by contracts, written laws, warranty contracts. Yeah, those are the legal, legislation and the likes. Now, what is constructive obligation? Because constructive obligations are not written. Constructive obligations are implied. Now, what do I mean by they are implied? Now, they are as a result of past practice that creates a valid expectation. Now, I will underline the valid expectation. So, in essence, what we're trying to say is that a constructive obligation arises as a result of what? As a result of valid expectation based on past practice or practices of a particular entity. Now, a typical example of this that can come to my head now is, let's take for example, a company is known to provide, to repair, right? To repair heavy damage goods returned, right? The company is used to repairing damaged goods returned within 20 days of purchase. Now, let me explain something here. Where a company repair every damaged goods that is returned within 20 days, and take for example that this is not written down anywhere. It's just based on the practice of the company. In as much as you show your receipt, that the company is willing to repair for you. Now, this is a typical example of, okay, before I move to that, let's say a company that repair damaged goods return within 20 days of purchases. Now, looking at this, for instance, for example, looking at this, if over time this company has created this kind of valid expectation for customers to think that, oh, if I get this goods with so company entity XYZ, it is sure that they are going to repair this thing if it is damaged within 20 days. Now, the company has created a valid expectation. It's not written down anywhere. Has created is not a legal binding. There's no contract that was signed. Has created a valid expectation in this case, which means that to a large extent that company has an obligation, a present obligation, which is a liability. So, like I said earlier, an obligating event can come as a result of legal obligation, which is contract, law, legislation, or constructive obligation. Constructive obligation comes as a result of what? Valid expectation. Okay. Now, a possible obligation, I've already said that. Okay, before I move to that, for example, a retail store that has a long-standing policy of allowing customers to return merchandise within, say, a 30-day period, like I just explained. Now, a possible obligation, we've already explained this as well, is disclosed but not accrued. So we are saying that if it is not a provision, or if the three criteria of the provisions are not met, and there's a likelihood or a possible obligation, then it can be disclosed, right? However, disclosure is not required if payment is remote. So disclosure is not required if the possible obligation is going to occur, let's say in like 10 years time. You don't have to disclose that because it's not a useful information to users of financial statements. Okay. All right. Now let me just quickly mention something on measurement of provision. So please take note. Measurement of provision, right, should be based on best estimates, right? Provision should be based on best estimate of the expenditure required to settle the present obligation. Please take note. Best estimate. Don't forget, these are estimates, right? These are estimates. And in IAS 8, we've learned that estimates can always change over years and it should be done prospectively. So these are estimates. Don't forget that. Best estimate of expenditure required to settle the present obligation. Now, yeah, that is the amount that will rationally be paid to settle the obligation at the reporting date or transfer to a third party. Now, it is also important that we talk about provision being one of event, for example, restructuring, environmental cleanup, settlement of a lawsuit, or yeah, and this can be okay. Before I move to the next one, it can be measured at the most likely amount. Most likely amount. Let's say, for example, somebody sued me to court and said, because I ate in your restaurant, I had a running stomach, food poisoning, and the person sued me to court. Now the question is, what is the likely amount I'm going to pay for that? Is it one-off? Okay. Two, provision of a large population of events. Now, what is this? For example, you are saying that, oh, you're selling 100 goods to people and you're looking at it, what is likely that so number of people will return this? For example, let's say, oh, out of these 100, we expect that 30% will return. That is a typical example of large population. And this is always based on probability weighted expected value. So this is always based on probability weighted expected value. So it is very, very important that you know that you use the probability weight. Why the one-off is the most likely amount. It's as simple as that. Now, these are very, very important because we have different scenario in a likely question on provision. Now, discounting. It is also important that you know that measurement of provision, yeah, are discounted at, so it should be discounted at pre-tax discount rate. should be it should be it should be discounted at pre-tax discount rate. Please let's take note of that. Now, most especially if it is going to be material, if the impact of discounting is material. If the impact of discounting is not material, then you might not need to discount. But if the impact of discounting is going to be material, then it should be discounted at pre-tax, not post-tax. Okay. Okay. I think that is that about that. Let's look at this illustration. I've explained what the constructive obligation is. We've explained what a legal obligation is. So I'm not going to dwell so much on all that. I'm not going to dwell so much on all that. Now, we've already talked about, okay, let's just look at measuring provision. The amount recognized as provision should be a realistic amount, one, and it should be prudent estimate of expedition needed to settle an obligation existing at the reporting date. Then it should be discounted whenever the effect of time value of money is material. We've explained all this. So it's as simple as that. Let's look at the illustration we have here. Please don't forget, you can download these notes at the description part of this video. Okay, now illustration 2. What is this illustration 2? Entity G has a financial year ending 31 December. On 15 December year 1, an employee was injured in the workplace and has sued Entity G for compensation under current health and safety legislation. Entity G solicitors believe that employees' claim has a 60% chance of success. The solicitor estimates that if successful, the claim will be settled at 20,000 naira required. Consider whether or not Entity G should provide for the claim at 31 December year 1, and if so, at what amount? Now, we are going to look at the question and just see the best way to approach it. There are two things: whether or not the entity should provide for the claim, that is there even a present obligation? And two, if there's a provision to be made, at what amount? Now, don't forget, before provision is recognized, there are three criteria. One, there must be present obligation. Two, there must be present obligation. One, two, the amount, it is probable that the amount is probable, right? Or the amount, it is probable that the amount, so it is probable that payment will be made. Then three, the amount the amount can be estimated reliably. Now, let's look at this question. First, Entity G, right? Entity G has a financial year ending of 31st December. On 15th, an employee was injured in the workplace and sued Entity G under current health and safety legislation. Now, the first thing is, what has this current health and safety legislation had to do with a present obligation? Don't forget, there must be a present obligation arising from past events as a result of an obligating event. Now, what is the obligating event here? The obligating event in this case is that the current health and safety legislation, right, is a what? The current health and safety legislation is a legal obligation. As a result of the employee signing a contract as an employee of the company. Now, that's the first criteria as a man. So there's a present obligation. Then let's move on. The entity solicitors believe that the employee claim has a 60% chance of success. That means that it is probable that they will pay that amount, or it is probable that an amount will be paid. Please take note of that. It is probable because the solicitor, who are the experts in this case, they are the legal experts. That is their specialism. They've said that there's 60% chance of success. That means the employee will have a success claim, 60%. That means it is very, very probable. It is more than 50%. It is likely than not. Now, the solicitors, right? The solicitors estimate that if successful, the claim will be settled at 20,000. So first, it is important that we note that one, there is a present obligation. Two, it is probable. Payment is probable. Payment is probable. Then three, amount can be estimated. This, we can see that there's an obligation from as a legal obligation. There's a legal obligation from the current health and safety from the current health and safety legislation, right? Payment is probable. There's a 60% claim, success claim. There's a 60% success claim, right? Don't forget that is in the question. This is it. 60% success claim, right? Then the amount, can the amount be estimated reliably? Yes, we're told that it's going to be a 20,000 claim if it is eventually successful. Now, consider whether the entity or not should provide for the claim. Yeah, we've considered that. And we've listed the three things: the present obligation, the payment is probable, the amount can be estimated reliably. Then, at what, if so, at what amount? It's very, very simple. 20,000 naira should be provided for. Just simple as that. So, a provision question, the first thing you need to look at is the three criteria. Are they met? Does the scenario, does it meet the three criteria? Then after that, you look at, oh, what is the amount we are going to pay? Just like this question has asked us. It's as simple as that. Okay. Now, let's move forward. We are going to look at warranty provision. We are going to look at some different types of provision. For example, we are going to look at warranty provision and guarantee. We are going to look at restructuring. We're going to look at onerous contract. We're going to look at yeah, those are the three major types of provision that we're going to be looking at in this session. Warranty provision. Now, what is this warranty provision? Now, many of us do buy phones, right? And when we buy phone, there's always a warranty that comes along with our phone, or probably an electronic item in our house. And this stuff, you know that, oh, if there are certain defects, especially if you've used the electronics or the item according to the instruction given by the producer, right, by the manufacturer, then you know that you're entitled to that warranty. It could be 1 year warranty or 2 year warranty, depending on the kind of product. Now, this is a typical example of provision that the company should make. Now, in this case, they provide the manufacturer, because the manufacturer has assured you to an extent that, oh, we are going to give you a warranty of 2 years. Then the manufacturer needs to make a provision for any defaults that will result in a customer bringing back the goods or the item to the company for repair. So this is a typical example of a warranty provision. Now, a warranty provision, a warranty is often given in manufacturing and retailing business. It is either express, maybe it is written, the design document, or implied, maybe constructed based on your past practice. You normally do a warranty. Now, under this, let's look at whether there's an obligation to replace, right, or to repair. So there can either be an obligation under warranty to repair or to replace. So this is very, very important because not as if they are two different things, but then it is very important that you understand that warranty can either be for repair to make good or for a replacement. The provision is required at the time of sale. Now it is important that we know this, that when there is a warranty for either repair or replacement, right, provision should be made at the point of sales rather than the time of repair. What we are saying is that is why at this point there's always an estimated probability weighted assumption to determine the particular number of or the percentage of people that are likely going to return. We're still going to get there. Now, you're going to look at it at the point of selling an item to a customer, right? This is always like a large quantity thing. Look at it. What is the probability that out of 100 customers that we sold to, how many percent or what percentage of those customers are going to return, right? Now, it is at the point of selling that you do this, not at the point where the customer is coming back to give you the product. Now, the provision is required at the time of selling rather than the time of repair or replacement, as the making of the sale is the past event which gives rise to what? An obligation. So we are saying that the obligation is at the point of sales and not at the point of repairs. This requires the seller to analyze past experience so that they can estimate. So as a seller, you need to estimate in the past. Now, how many claims will be made? If manufacturing techniques improve, there may be fewer claims. So you need to look at it in the past. Oh, what has been the claim? The claim has out of 100, 20 people usually come back for either repair or replace. Now, out of those 20, what have we done to improve our product? If there's any technological or technique improvement, then that could reduce that 20 to like 15. So you need to examine all these. 2, how much each repair will cost as technology becomes more complex. 3, okay, the provision setup. So those two things are very, very important that you clear them, you understand them. Now, this might not be for example purpose, so it's good to just make do with this understanding. Just have an understanding of this. Provision setup at the time of sale is the number of repairs expected in the future time at the expected cost of each repair. So we are saying that, if you are saying that you are going to repair this particular product, what is the probability of the people coming to return? What's the probability? 20% of the 100 goods is going to be returned. Then what is the cost in the future for such amount? Then 3, should be reviewed at the end of each accounting period in light of further experience. Let's look at illustration 3 to examine this. Now, illustration 3. An entity sells goods with a warranty covering customers for the cost of repairs of any defects that are discovered within the first 2 months after purchase. Past experience suggests that 88% of the goods sold have no defect, 7 will have minor defect, and 5% will have a major defect. Now, if minor defects were detected in all products, the cost of repair will be 24,000. Take note of all products. So you need to check it, how much per product. Now, if major defects were detected in all products sold, the cost will be what? 200,000. What amount of provision should be made? Let's quickly examine the question before we solve. First, is there a present obligation? Yes, there's a present obligation because there's a warranty in the notes, right? Covering customer for the cost of repair. Now, They now said, based on past experience, they've even been doing this over time. They know that 88% of the goods sold will have no defects. But 7% we have minor and 5% we have major. Now, they now gave you the cost, which can help you estimate the amount, right? So it's as simple as you knowing that one, there's a present obligation. Number two, it is probable that you make the payment. Then number three, the amount can be estimated reliably. So let's just look at this quickly. Now, okay, now let's look at, we were told that 88% no defect, right? Then we're told that 7% minor defect. Then we're told that 5% major defect. Now, what is the total number of goods that was sold? Were we told? Okay. Okay. An entity sells goods with a warranty covering customer for the cost of this. Okay. What amount of provision should be made? Now, okay, let's just look at it from this point of view. If 88% there's no defect, 7% there's a minor defect, and 5% there's what? There's a major defect. Now, it's simple. Let's check the question again. A particular number of goods should have been sold. An entity sells goods with a warranty covering the cost of repairs of any defects that are discovered within the first 2 months. Past experience suggests that 80% of the goods sold will have no defect, while the 7% will have minor defect, and 5% will have a major defect. If minor defects were detected in all products sold, the cost of repair will be 24,000. If major defects were detected in all products sold, the cost will be 200. Okay, so they just gave us the total amount of what was sold. So we are not to bother ourselves too much on the particular the particular unit of what was sold. Now, looking at that, it's very simple. What we can do is, now, if 88% there's no defect, that means the amount of provision will be nil because there's really nothing to provide for. Now, they said 7% we have minor defect, and if we are to repair those that have minor defect, they said the cost of repair is going to be 24,000. Now, it means that 100%, right? 100% of goods, yeah, 100% will cost 24,000. That's what the question has said. That if minor defects were detected in all products, which means 100%, they will pay. They are going to incur a cost of 24,000. But then we have based on our past experience, we know that it's just 7%. Now all I need to do is just have what? 7%, right? 7%, 7% of 24,000. So 7% times 24,000, that gives us 1680. That's the provision that will be made on the total number of goods that was sold. Now the next one is, if there's a major defect, which we expect just 5% to have major defect, we are going to be spending 200,000 on all the goods, which is 100% on all the goods. But now we expect that it's only 5% of this 100% that we have a major defect. So we do 5% times 200,000, and that gives us 10,000. Now, that is that about this. The total amount of provision that should be made by the company is 60,000. Sorry, 11,000. Should be 11,000 680. It's as simple as that. So don't forget the total cost if all products have minor defect, if 100% of the product have minor defect is 24,000. And we're only expecting 70% of that 24,000. So sorry, 7% of that 24,000. That's what we did. That then 5% for major. And if we are going to repair the whole product that was sold, is 200,000. And we expect just 5% out of that whole product to have a major effect. Then we just do 5% of the 200,000. That's how we got 10,000. Then the total is 11,680. Now, what is the accounting entry? The accounting entry is debit provision. Sorry, debit your P or L and credit your provision for warranty. With how much? With 11,680. This is a liability, and this is in your statement of profit or loss. Okay, so that is that about that. Let's just quickly look at illustration 4 that follows. Illustration 4. A manufacturer gives warranty at the time of sale to buyers of its product. Under the terms of the warranty, the manufacturer agrees to repair or replace any faulty product free of charge within 2 years from the date of sale. Experience over the past few years has shown that the cost of such repairs and replacement each year has been about 5% of total sales revenue from the product. Annual sales of the product are 1 million. Consider whether or not the manufacturer should provide for warranty claims on 30 June year 2, and if so, at what amount? Okay, so let's look at the question a bit in more details. So we're told that the manufacturer gives warranty at the time of sale to buyers of its product. Under the terms of the warranty, he agrees to either repair, is one of the two, any faulty product free of charge, right, within 2 years. So that means within 2 years, the warranty period is 2 years. Experience over the past few years have shown that cost of such repairs and replacement each year has been 5% of the total sales revenue for the product. Annual sales is 1 million. Consider if the manufacturer should provide for warranty as at the end of the period. Now, the question is, why shouldn't the manufacturer do that? Because in the first place, there's a terms of warranty which has brought about the present obligation. The obligating event is a warranty in terms of the warranty. Now, based on past experience, you've been able to estimate the amount, which is what, 5% of the total sales. It's as simple as that. Now, what is the probability that it will happen? Because based on past experience, you've seen that 5% of people usually come around to return or repair. So it's probable that 5% will return. Then what is the amount? The amount is just a minute. Experience over the few years have shown that the cost of such repairs and replacement of the year. Okay, now so we've been told that over the years, for the total number of people that come, the eventual amount that we spend or we incur is always 5% of the cost, sorry, of the sales value. So in this question, is as simple as saying yes, the manufacturer should provide for warranty, right? The manufacturer should provide for warranty. Very, very important. Now, at what amount? Because that's what we've been asked to do. Now, what is the reason why the manufacturer should provide for warranty? So we can put because, one, there's a present obligation. from terms of the warranty. 2, payment is probable from past experience. Then 3, amount can be estimated reliably. We're told that 5% of what? Of revenue. So those 3 things are in the note. So as simple as that. Now, what is the amount to be made? So the provision is 5% of, we're told, 5% of the total sales value, which is 5% of 1 million. And this will give us 50,000 naira. That is the provision. Debit your P&L and credit your provisions. As simple as that. Okay. So the question around provision is always quite simple in terms of what an examiner can ask you to do in an exam. Straightforward. You just have to understand how to go about the question and also ensure that the 3 criteria are met. Because if the 3 criteria are not met, then you just have to disclose it. Now, that will bring me to guarantees. Now, there's a warranty and there's also a guarantee. Guarantee is more assuring that, oh, we are sure that this thing is not going to get spoiled. It has been tested that, oh, for example, the screen of this phone, no matter how you do it, let it fall from so number of floors, it's not going to spoil. That's more of a guarantee than warranty. Warranty is just like, oh, if eventually it happens, can you just bring it? We are going to repair for you. Now, I'm just going to look at the illustration on guarantee shortly. Then we can now go to some other things in. We can now go to some other things in the question in the notes. Now, for guarantee, very similar to warranty, so that's why I'm not going to dwell on the explanation of what a guarantee is. Provisional Code issued a 1-year guarantee for faulty workmanship on a single item of specialist equipment that is delivered to its customer. At the company's year end, the company is being sued by the customer for refusing to replace or repair the item of equipment within the guarantee period. Now, as Proviso believes that the fault is not covered by the guarantee, but instead as arising because of the customer not following the operating instruction. The company's lawyer had advised Proviso that it is more likely than not they'll be found liable. So what we are saying there is that whether the guy likes it or not, whether the manufacturer likes it or not, they are going to, whether they like it or not, they are going to do what? They are most likely going to be liable. Now, based on past experience, liable, then this would result in the company being forced to replace or repair the equipment plus pay court costs and a fine amounting to 10,000 naira approximately. Based on past experience with similar items of equipment, the company estimates that there is a 70% chance that the central core would need to be replaced, which would cost 40,000 naira, and a 30% chance that the repair would only cost about 15,000 naira. I'll take that again. Based on past experience with similar item of equipment, the company estimates that there's a 70% chance that the central core will be replaced, which will cost 40,000, and 30% chance that the repair would only cost about 15,000 naira. That's the first scenario. 2, The company also manufactures small items of equipment, which it sells via a retail network. The company sold 12,000 of this type this year, which also have a 1-year guarantee if the equipment fails, based on past experience. 5% of items sold are returned for repair or replacement, right? 5% of items sold are returned for replacement, right, or repair. In each case, 1/3 of items returned are able to be repaired at a cost of 50, while the remaining 2/3 are scrapped and replaced. The manufacturing cost of a replacement item is 150 naira required. Discuss the accounting treatment of the above situation. Now, let's just look at them one by one, then we can sort it out. The first one, we're told that there's a compulsory amount that will be paid as fine, 10,000 naira. Now, when I was talking about these whole measurements earlier, I said some are one-off, while some are probability weighted. Now, a typical example of the one-off is what we've looked at in our other questions, and this 10,000 naira is actually a one-off payment. But then the other bit, which is the 70% chance and the 30% chance, those are probability weighted. Then also in the second scenario, there's a 1/3 and 2/3, I think. Those are also probability weighted. So we're going to look at this and see how we're going to solve the two scenarios. Now, at this point, I'm not sure I need to keep going back to explain the three criteria because it's pretty straightforward. Number one, there's a present obligation since there's a guarantee in the first place. Then number two, you were told that the customer is more likely. So it is probable. Then number three, you know what amount you're going to be paid. It can be estimated reliably. So I'm not going to spend much time on that. Now I'll go straight to the first bit. And the first bit where we are talking about where proviso 1-year guarantee or issue. First, I'm going to put fine as part of my provision because it is not sure. They are just saying that if it eventually happens. So that is why it's going to be a provision. Now, I'm going to put a 10,000 naira. Then two. They now said there's a probability that 70% chance that the central core will need to be replaced, which will cost 40,000, and 30% chance that the repair would only cost about 15,000 naira. Let's take that again. Based on past experience with similar item of equipment, the company estimates that there's a 70% chance that the central core would need to be replaced, which would cost 40,000, right? And this is not all. And a 30% chance that the repair would only cost about 15,000 naira. Okay, I think let me do something. Now, at this point, we're told that let's just look at it. This is the part that I really want us to look at carefully. Based on past experience with similar items, the company estimates that there's a 70% chance that the central core would need to be replaced, which would cost 40,000 naira. And there's a 30% chance that the repairs would only cost about 15,000 naira. So 70% chance that there will be what? They will be replaced. Don't worry, let me write it so it's clear. 70% chance for replacement. It will cost 40,000 naira. And there's a 30% chance for repair, which should cost 15,000 naira. Now let's go up and check what the question has said. Are they going to do the two, or it is just one of it that they will do? Now, the company lawyer had advised that, okay, first, guarantee that fault in a single item of specialist equipment that delivers the customer. At the company's end is being sued. Okay, that's not what I'm looking for. The company lawyer has advised people that it is more likely than not that they will be found liable. This will result in the company being forced to replace or repair the equipment. So the company is either going to replace or repair the equipment, which means that the company is not going to do the two at the same time, right? But then there's a 70% chance that is going to be spending 40,000, and there's a 30% chance that it's going to be spending 15,000 naira. Now let's do the probability weight: 70% of 40,000 and 30% of 15,000. This gives us 28,000. This gives us 4,500. So the weighted probability of provision that should be done, that should be made, is the 28 plus 4,000. But then we now have fine, which needs to be added to the provision, which is a one-off. Now that will give us 28,000 plus 4,005 plus 10,000. That will give us a total of 42,500. That is the provision that should be made. Now, let's look at the second bit. The company also manufactures small items of equipment which it sells via a retail network. The company sold 12,000 items. 12,000 units, right? The company sold 12,000 units of an item this year, which also have a 1-year guarantee. Based on past experience, 5% of items sold are returned. So returned 5%. 5% of 12,000 that will give us 600 units, right? So they are either repair or replace. In each case, 1/3 of items returned, 1/3 of items returned of 600 units, right, are able to be repaired at the cost of 50 naira. Where the remaining 2/3 of 600 are going to be repaired at 150. Now, what I want us to try and check is it per one unit? Is the 50 naira 150 naira per one unit, or a total? So we need to be sure of that. Based on past experience, 5% of items sold are returned for repair or replacement. In each case, 1/3 of items returned are able to be repaired at a cost of 50, while the remaining 2/3 are scrapped and replaced. The manufacturing cost of replacement item is 150. So I'm going to be assuming in this case, that to repair 2/3 is 50 and to replace 2/3 is 150, not per unit, because the question did not say per unit. But if it was per unit, then I would have done 1/3 of 600 times 50, which is per unit in that case. But in this case, we are not told that it's per unit. So times 200, sorry, 50 plus, which gives us 200. It's as simple as that. So what is going to be the accounting entry for this? Debit, POL, and credit provisions with 200 naira. It's as simple as that.